You tell me if yesterday's classroom has any resemblance to today's marketplace. It's crazy, isn't it? So we need people to be getting these trades. We need people to be getting this bit of business. Now, obviously, this is all subject to the value being bullish. So we talked about the high betas. We talked about the high betas. Is that not a spring there, Jerome? Is that not a spring trade just there on a lower time frame? So yeah, we did get it. We did get the spring as well. So when we look at this as a narrative, one of the things we're looking for is the high beta narrative. Is the high beta value line bullish? Yes or no? It's crazy, isn't it? So the high beta line, in line with that value narrative, was bullish. This is the classroom we did yesterday for the question that we got yesterday morning in classroom. What line do we use in the London session? I said the high beta line. And what other line did we tell you about yesterday? We told you about the risk profile line, didn't we? The bonds gold. Was that bullish or bearish? Bullish, right? So we've got this massive value divergence into this massive buy-side accumulation. And it's got to be your trade. It's got to be your trade. It's absolutely got to be your trade. There's no ifs, there's no buts. It's got to be part of your business right there. And it's obviously the perfect time of the day. It happens between 7 o'clock and 8 o'clock, as we normally expect it to happen between 7 o'clock and 8 o'clock. They take the price down for 8 o'clock. So it's got that structural component of the trade as well, which is nice. Always nice to see that. And all we do is buy up lots and lots and lots of equities. And obviously, after we've bought lots and lots of equities, what happens? The price drives beautifully to the upside. That's what happens. And we said yesterday, if you can count to 3, you can make money. And when you look at this setup versus the reality of yesterday's setup, remember we had the Photoshop of yesterday's setup as well. Take a look at yesterday's setup. Take a look at today's setup. I mean, what's going on, right? Seriously, what's going on? It's just like, how can we make it pretty much almost identical to the previous day? It's just so crazy obvious what actually is going on. They take the price down to accumulate a long position. Yesterday, it was into the US Open. This morning, it was into the London Open. And you can see that this is the exact same process. It's the exact same process. There's nothing else about it. There's nothing else that we need to look at. There's nothing else we need to comment about. It's just exactly the same. And when we think about that as a process, when we think about that as a storyline, as a narrative, the one thing that we keep talking about is we must have it. We must understand it. We must have that knowledge to say, I know what they're doing. I know how they're trying to get me out. I know how they're trying to take me off the deal. I know how to deal on that basis. I know how to be available to make some money on that basis. So it doesn't matter what they throw at me. I know how to play it. Whether they throw at me a lot of sellers or whether they throw at me a lot of buyers, I know how to trade this. And this is what we're looking for. And as I said, when we look at the risk profile line, we can see that that risk profile line 100% agreed with the entirety of that trade. It's beautiful. but they still challenge you to be a good trader. You know, buying the breakout high would have cost you a lot of money. You think about if you says, well, you're going to join the world of retail trading, and then you bought here. Well, Ray said it's bullish, so surely I can buy it at the top edge here. And then you say, well, that didn't work. I lost a lot of money, Ray. Thanks very much. And then you saw another breakout buy trade opportunity there, and you bought it again and says, right, oh, damn it, I've gone and lost money again. Thanks very much, Ray. I'm not doing very well with this idea. Yeah, that's because you're a numbnuts, to be honest. And then you see the breakout trade here, and you go again, and you say, Ray, I'm going to go again into this trade. Ray says, keep going after this as a buy trade. And you buy it again, and all of a sudden you get stopped out for the third time. Yeah, because you're a crap trader. That's why you get stopped out for a third time. You're paying retail prices for something you should be paying wholesale prices for. This is the cannon fodder that gives me my buy trades at these dips. These buyers at higher prices are sellers at lower prices, so we take advantage of those guys, right? You don't want to be those guys. And it's easy to not be those guys. You just don't take those trades. As a basic process, you simply do not take them because you are going to get annihilated. Even if you're right, you'll still get annihilated. I've looked at this relative value stuff and I never make any money because you pay stupid prices. You buy at a premium, not at a discount, and you sell at a discount, not a premium. That's why it's not working. That's why you've got to fix that type of thing. And you've got to recognize that when it's such a good deal like this, that they will try and shake you out as often as possible. They will go after you, they'll go after you, and they'll go after you again to shake you out as much as possible off a deal. Did anybody get the retest short oil again? Now, we've been working this oil short, but they did exactly what I've just talked about there. Exactly what I talked about. They challenged you to show that you've actually got some confidence about what the hell you're supposed to be doing, right? Is this a short sale, yes or no? Was that a short sale? Yes, it was. Did we get a short sale? Yes, we did. Did I show you the screenshot of that short sale? Yes, I did. What did I tell you? I don't like this shape forming here and I'm booking some money. So what did they do? They challenge you to see whether you've got the balls to do it again. Have you got the confidence to step back in again and take another shot? Well, damn right we did. So I resold it back into the top edge. I even got a chance to put it in Ninja Trader, and there it is. So there's the second short. So I've got the confidence. The value's got better this time, and I've got a good premium price. So I simply waited for the Heisman opportunity, and then I sold it. A Heisman trade. My God. So fucking easy. It was unbelievable. And all of a sudden, we've just taken a little top edge 50, 85.50s, down to a low price there of 85.20s for $300 per contract on the sweep. $300 per contract on the sweep. Absolute perfection, isn't it? But it's just that idea that they know that you know, and because they know you know, they want to make sure they challenge you to be a good trader. So they rip it higher, get the stops, get rid of you if you're a bad trader, recognize the good traders are adding to the short, not taking the short off, adding to the short. So we sold here, we took some profits here, we added to our short here, and then we ripped it. So when you add to your short position, the market maker recognizes that you're competing for them, with them, for those short sell positions. So they pull the liquidity so that they stop you competing for those positions. And all of a sudden you get this big rip sell side and we make a lot of monies into the level 2 liquidity. And there's our target price right there at 20. And we bag some monies. And we say thank you very much for another $300 sell side loveliness. Crazy, isn't it? Crazy. RBOB, well, that's a problem, isn't it? This is why I'm booking aggressively, because RBOB looks really bullish today. So I'm going to book these as aggressively as I can when we hit these liquidity levels. Because RBOB is not our friend on the sell side today. At this point, at least at this point. So, nice trade. Nice outcome. Fast, furious, easy money. Get the easy stuff and the rest will look after itself, guys. Get the easy stuff and life should be relatively plain sailing for you if you're just consistent, waiting for the good stuff and then executing. This happens all the time. That sell trade is almost identical. Sorry, that buy trade is almost identical to that oil short, isn't it? It's almost exactly the same on a different scaled chart, isn't it? If you look at that as a buy trade, and then I pop oil onto that same screen, and then you look at this as a sell trade, is it not exactly the same, Paul? So we get the value divergence coming in from this rejection here, right? So from that point, we could count this as basically the one phase, and then we get a sell candle, and then we could count that as the two phase, and then we get a sell candle, and then we count this as a three phase. If I take that down to a 1 minute chart, it'll be a lot clearer for you to be able to recognize it. Crystal clear. Because there it is now on a 1 minute chart. You'll see it for yourself. So the value diverges at this point here. So there's your first line, isn't it? So the value diverges off of that high price. So there's your first line. So there's your first price there. There's your second price there. There's your third price there. And there's your third price again. So you get, it doesn't go any higher than 3. We just leave it at 3. The first sell rejects and then runs a sweep at 85.50. And then the second sell sells off. Get a little pause in the mid price area here. And then we get the sell coming in and we get this beautiful sell side reversal. Stunningly valuable. Big value in this from the swap dealers, isn't it? So with a big value from the swap dealers, we've got to be short. Got to be short. So I'm waiting for this trade. And that's the best trade of the day, isn't it? Look at the prior sell. How much value did I have in the prior sell? How much value? None, right? So because there's no value, they don't have to try and get rid of it because nobody's on it. You understand the difference? Because it's just basically a fair value drop, anybody that wants to sell that has to now chase the short. They don't have to take it higher. They don't have to try and get rid of anybody because nobody's in it. Does that make sense? Nobody's in it. So when you see that the value's fair and nobody's in it, if you want to be selling that, you have to jump the spreads. You have to jump. You have to cross over to get the sell going. And that's why when there's no value, the price goes faster. Because there's no value. Everybody that wants a piece has to cross. Everybody crossing equals aggressive sell side order flow. Whereas the value is very obvious here. And because the value is very obvious, how fast do they take the market sell side? They don't. They take it up, not down. They take the price up because the value isn't fair. Because the value isn't fair, the idea is, well, let's try and get rid of these sellers because it's too obvious. So we've got to take it higher to get rid of the sellers. Bring in some buyers and let's take some money off them. And then when the buyers come in, now we've got a chance to accumulate that short position. Rattle it to the downside. But It takes you about an hour to get short. It comes back and it tests you and you go, come on to grips here. What the hell's happening? That's your comment from a retail trader. From a commercial trader, the commercial trader is saying, oh yes, I like this. I'm getting more size and I'm getting a better price. I love this deal now. And the higher she goes, the more we like it, right? The higher she goes, the more we like the deal. So long as the value doesn't flip on us at the same time. So long as the value stays in place, we want it to go higher for longer. It's the exact opposite to what you want. You want a fast money, quick response to that selling. And you're not going to get it when it's got great value. So you've got to understand that you've got to work these offers. You got to work the offers. It's going to take time. It's going to take time. So you count once as the high with value, twice as the first level 2, and 3 times is usually the end of the move. Sometimes it goes again for 4. And then the roll back to the downside, which is beautiful. If you can find just that one trade every day, that's all you need, guys. That is literally all you need to be successful as a trader, is that one trade every day if you can find it. 1 minute charts, 5 minute charts. This is a 1 minute oil chart. It's visible on the 5. Clearly visible on the 5. If you can find that one trade every day, that's it. So it's visible on the 5 minute. It's visible on the NASDAQ today as well. It's been visible on the gold today. It's just that easy money narrative that we can look for every single time to try and figure out, there it is. There's the bad boy right there. The idea of getting liquidity is incredibly important. It's as simple as that. It's incredibly important. If we don't get liquidity, the trade's done. I mean, it's already gone from us. And for the algorithms, that's fun, and all that great stuff happens when the world of the algorithms kick in and they all drive the price. And if you're a momentum trader, that's what you're waiting for. But as a commercial trader, what I need to see is I need to see a buyer. I need to see buy side liquidity at higher prices for me to sell into. And if I don't get it, I'm probably going to sit here with nothing on the trade, and I'm going to be watching everybody else making some nice monies, and I'm going to be pissed off. So it's important for us to get some of these types of trades every day, see these accumulation type trades taking place. And the bigger the value, the more chance that we'll accumulate for as long as possible, because it's in the commercial interest to do that. Now, there's some trades that have a turtle event taking place, and some of these trades that have turtle type markets. One of the best turtle markets we talked about was the dollar. Somebody asked the question yesterday about the US dollar. Who was it? Was it Nuno that asked the question about the dollar yesterday? Or was it Tad? I'm not sure who was asked the question about the dollar, but somebody asked a question about the dollar and its relationship to interest rates. And I showed a good example of this this morning when we looked at the US dollar itself. Take a look at a 30-minute US dollar chart and tell me if this is like the best turtle trade. 30-minute US dollar, guys, is this the best turtle trade you've seen? The best trending market you've seen? Look at that beautiful trend, isn't it? A beautiful trending market. One of the questions was, what about US interest rates? How do we know the direction of the US dollar? Because if we know the direction of the US dollar, what else do we know? We know the direction of the pound. We know the direction of the euro. We know the direction of the Aussie, right? So it's a really, really, really important piece to know about. It's a really important question that we're trying to answer against, for example, top line liquidities. For example, at bottom line liquidities. It's a really important question that we're trying to answer in and around these areas. Now, you can trade this as a turtle. And what do turtles use? Channels, right? The turtle uses a breakout of a channel. Do the turtles make any money on this market? Yes or no? Turtles make a fortune on this market, right? The turtles would make a fortune on this market. Let's just check to see if the turtles do make a fortune. Do the turtles make a fortune? Yeah, make a fortune, don't they? So you can see the turtles can make a fortune in this market just by following this market, can they? Sell side business, big drop. Buy side business, big rally. Sell side business, big drop. Buy side business, big rally. Sell side business, small drop. Buy side business, good rally. Sell side business, good drop. Sell side business, brilliant drop. The turtles just roll in cash when they trade the dollar. But the interesting thing about the dollar is, of course, it's identical to the pound dollar. It's identical to the euro dollar, pretty much. It's almost identical to dollar yen, Aussie yen, for example. The other interesting thing is the Aussie yen should be leading these trade triggers, shouldn't they? Because Aussie yen's a far higher beta than the dollar index. So when I put Aussie yen on the charts, does it lead the market? You can see it leads that short sell into that narrative, doesn't it? Very nice indeed, in fact. But what's a better indicator? Because obviously you compare Forex to Forex, you're bound to still find some trouble. So what's better to trade? Well, the bond curve. If I look at the bond curve, of course, what we've seen in the bond market is we've seen a big movement between the knob spread. We've seen it going from a 3x1 to a 5x2, and then from a 5x2 to a 2x1. And the reason why that happens is because yields move so much that the spread DVO1s need to be rebalanced, and there's a more accurate rebalancing. The good thing is that the knob spread 3x1s, 5x2s, and 2x1s provides us with a very simple plus or minus 3, plus or minus 2 narrative, right? So we always know whether bonds are long or bonds are short. If I know bonds are long, we know that the dollar is short. If I know the bonds are short, we know the dollar as a rule should be long. So when I look at those spread ideas, and I work my way through the spreads here, we showed this morning, the idea is very straightforward. If I look into a balance area here, and I look at this spread here, can we all agree that this green line is going up and the blue line is going down? Well, if the green line's going up and the blue line is not going up, and I sell the green line, what's the green line? 2x1s. 2x1s. If I buy the blue line, what am I buying? 3x1s. So if I'm buying 3x1s and I'm selling 2x1s, what's my net bond position? Net bond position. Selling 3x1s, buying 2x1s. Sorry, buying 3x1s, selling 2x1s. I'm long a single bond, right, Justin? I am long one single bond. If I'm long bonds, what should I be doing on dollars? What should I be doing on dollars? Sell side dollars, right? I should be selling dollars. So when I look at that as a narrative, I should be with the turtles, shouldn't I? I should be selling with the turtles during that period. And that sell stays in place because you can see during this balance as well, take a look. So this one was going up and this one was going down. And this one was going up and this one was going down. Same thing again, isn't it? Same thing. Sell side dollars again, sell side again. I should be with the turtles. So in other words, any sell trigger that the turtles come up with here, and any sell trigger that the turtles come up with here, I should be selling. Any buy trigger the turtles come up with, I should be fading. So when the turtles come out with a buy trigger, I should fade it, right? I absolutely should fade it. There's a turtle's buy trigger. How does a turtle get a buy trigger? Because they trade into liquidity. So that is buy side liquidity. So when I see buy side liquidity in this, I sell to it. There's the perfect sell. The perfect sell. And then we get the turtles coming in, which is sell side liquidity, but the sell side liquidity is correct. And the price now drops beautifully. Look at that drop. And as we came into the drop, guess what happened? We balance in the overnight session. This line goes up. And this line goes down. If I'm selling 2 bonds and I'm buying 3 bonds, what's my net bond position? Plus 1 bond. If I'm plus 1 bond, what should I be doing on the dollar? I should be selling dollars. And there's a dollar short again. And I was buying pounds this morning against the dollar. I was long sterling against the dollar this morning for a lovely little trade. Easy money trade. Simple stuff done well, isn't it? Simple stuff done well. And it's happening again, believe it or not. Look. It's happening again, isn't it? Look. And you're looking at that rally in the dollar and you're saying, this should be a short. This should be getting shorted on the way up here, shouldn't it? Simple stuff done well, guys. That's all we ever look for.